Our guest says with the prospect of the S&P 500 companies increasing their earnings by close to 10% this year, he reckons the bull market is still intact, although its angle of ascent has been reduced. Let's bring in Sam Stovall, Chief Investment Strategist at CFRA. Sam, great to see you. So the indications are that U.S. profit growth is intact, but of course we don't know how bad the tariff damage is.
Exactly, Andrew. Certainly we have what I call a manufactured correction that could be changed at any time. So I think investors are nervously waiting for April 2nd to find out whether these tariffs are truly reality or simply rhetoric. So unfortunately, you just have to sort of follow the trend of the market in the near term, anticipate that this correction might go down to even the 5,400 level on the S&P, which would represent about a 12% decline before we start to turn around.
A 12% decline from current levels, Sam?
12% decline from the February 19th peak, which would put us close to the average correction. We've been down 10% already. But I remind investors that since World War II, the average time to get back to break even from a correction or a decline of 10 to 20% is only 4 months.
Oh. That's interesting. Sam, my dad used to joke that when you bring your car into the mechanic, you don't want to hear them go, because you're going to be paying a lot. You reckon that investors out there looking at the market, a lot of them are going, I don't want to buy stocks, but that can be a good sign.
Oh, absolutely. There are several reasons for that. First off, we see the percentage of companies trading above their 50-day moving average dipping well below the oversold condition in both the S&P 500 and in the NASDAQ. You take a look at the CNN Fear Greed Index, and it's in extreme fear category right now. And the American Association of Individual Investors, or AAII, they do a survey of their members, and right now the bullish reading has not been this low since the bear market of 2022. So it sort of reminds me of Baron Rothschild, who said the time to buy is when there's blood in the streets. Of course, a 10% decline really isn't that bloody, but still, I think there's so much negativism out there that it makes me feel that we're due for at least a near-term pop.
Of course, it's hard as human beings to count our blessings, isn't it? But we had 2 lush, soft years in the U.S. market.
Absolutely. And it's very hard to have what's called a three-peat, meaning 3 successive years of double-digit increases following a down year. That's only happened 1 in 5 times since World War II. And also, I think tech investors have to realize that they've been very fortunate because the S&P 500 tech sector has gained more than 30% in 6 of the last 8 years. So I think it's time certainly for a little bit of a breather.
Looking back, we often hear the stock market and the economy are not the same. If American growth is curtailed by the tariff war, is it conceivable the stock market could hold up reasonably well?
Well, there's Paul Samuelson once said that the stock market has anticipated 9 of the last 5 recessions. So yes, investors are anticipators, and sometimes they do get ahead of themselves, especially when they are being nervous and they want to take profits. We are not looking for a recession at this point. We still see GDP growth at or above 2% this year, 2.3% next year, but the market does anticipate recessions by an average of about 7 months. And so that could end up putting us into September if this did end up being a recession. The good news, however, is that the market also anticipates the end of a recession by about 5 months. So once the NBER, National Bureau of Economic Research, tells us we're in recession, is probably the time to buy.
Sam, you've been following the markets for a couple of years now. Have you ever seen anything like this level of policy volatility and uncertainty in Washington?
Well, a little bit. If you harken back to 1993, we had the health situation, Hillary Gate, as they called it back then, where the new Clinton administration was trying to make a lot of changes into the U.S. healthcare system. And so the healthcare sector itself went into a tailspin, primarily because you had the pharmaceutical stocks that represented more than 65% of the weighting of the healthcare sector. That's certainly played itself out. This time around, however, we're looking at policy that's affecting the global economy, so certainly on a much grander scale.
Yeah, and I was watching the Vietnam War documentary series on Apple, and I mean, back in 1968, 1969, they were brutal times in America, cities burning, demonstrations. So, you know, we think this is terrible, but America's been through troubled times in the past.
Absolutely. Unfortunately, we did end up in a recession and bear market in the late 1960s, and the 70s themselves ended up in a stagflation environment. That's something investors are hoping does not repeat itself this time around, even though Fed Chair Powell was hinting that economic growth is slowing while inflation is remaining fairly elevated and sticky. So we'll have to see whether we do end up maintaining some GDP growth and renew the downward trend in inflationary data.
Sam, thank you very much indeed for joining us.